You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome to this edition of the Systematic Investor Series with Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, where we do our best to bring you into the world of rules-based investing by sharing our observations and hard lessons learned over the last few decades, hoping that you can avoid making some of the mistakes that we did. Jerry, Moritz, good morning, good afternoon. Not long since we were together in Miami. Now we're back in our respective homes. How are you doing?
Doing well. Had a short flight back to Tampa, but I trust you guys made it back home okay.
Yeah, doing well. Bit of a longer flight. Got back here about 2 or 3 hours ago, but all went smoothly. So that was very nice to see you.
Absolutely. Good stuff. And really nice to catch up in person last week. Of course, as I would say often happens nowadays when we do get together for these conferences, there always seems to be something interesting happening in the markets. And of course, we're recording just as the month of January finished. So maybe we can look at it in a little bit of a bigger picture, not just for the last week, but for the last month. And of course, we did have a solid start to 2020. Lots of trends continued in their path. But then, of course, we got hit by this coronavirus, and kind of all bets were off in terms of market trends. And I think, for the past 10 days or so, but certainly this week in particular, many of the markets that we trade were dealt a bit of a blow in terms of their trends. Equities, energies springs to mind, but even some of the commodities, not necessarily related to coronavirus, but I did notice that coffee was down 22% in January, for example. But as market closed on Friday, it was pretty clear that investors preferred safety in fixed income markets where Treasury yields just dived pretty low. I think the 2-year went down to 132, which is the lowest level we've seen in 3 years. And the 10-year is down to 151, not far from its low. And gold, of course, was another favorite from investors at the expense of the more risk-on markets. So I know you just came back, Moritz, maybe yesterday in sunny Miami or maybe cloudy Miami. You had time to look a little bit on what's going on in your portfolio while you were spending time in Florida.
And that's exactly how I did it and what I did yesterday morning in Miami, because it was overcast and it started to rain. So I ran my portfolio and looked at the numbers and, doing the thing, and found out that I lost 1%. Close to 1% last week. But I finished the month up about 3.5% still. So I'm not complaining about that. But last week saw some relatively large moves that we hadn't seen in a while. Obviously lost money from being long equities in China, in the US, in Russia. Made money on the US bonds, made money on being short copper, long the euro dollar, and short cotton. But, it's been a back and forth, so minus 1%.
Yeah, which, for the week, but still up for the month, which is pretty good. We were not quite as profitable as you. We were more in the flat to slightly up camp at the end of play on Friday. But even though, it was kind of a very flattish month at the end of the day, of course, intra-month gave back some of the open equity. And when you look at the market breakdown on our side, certainly there was quite a lot of diversification in terms of returns. It wasn't a quiet month when we look at individual markets, but of course equities on our side as well were generally down. Energies as well, some of the energies down more than others. Very few positive performance from energy, but nat gas was one of them. Interestingly enough, our best market last month was the lean hogs. So nice to see that some of the smaller markets are participating. But of course, the clear winner in terms of that was also fixed income on our side. Not surprising, we'll see how that all plays out. Whether this is again one of those 2 or 3 week corrections, and then investors comes back and the trends find their foot again. So be interesting to see. But since equities did play a central role in January, Jerry, it's always interesting to see whether some of the individual equities also saw some interesting moves. So how was your month, week?
Probably fared a little bit better than the S&P. I think those big stocks got hit a little bit more, especially Friday. I'm lucky enough, I don't feel the need to trade a little over 30 individual stocks. So, and it's just a portfolio built on weirdness, crazy names, stocks, that are not normal or have different things going on, but with liquidity, and certainly most of them household names. But I was fortunate enough to get a hold of Tesla, and I think that bucked the trend of last week. So I think that was even up on Friday. I did have at least one stock that's heavily tied to China. I think it does business in China, or it might be China-based. They got pretty crushed one day. The first day the sell-off came. So yeah, it's interesting because I've said before, you can build these portfolios looking at lots of data, which you should look at. What is a lot of data? Well, certainly more than a few weeks, and then you put it together and you have this diversification, whether it's stocks or commodities or bonds and currencies. And then you could get all these sectors are going to get hit. And your diversification kind of goes away. And, so your only defense really is hoping that you had some longs and shorts in some different positions. So when they do all get hit, at least you're making money on some and losing on the others. But, and then maybe everything goes back to the situation before where there was less correlation, but we just never know. You just do the best you can, and I think the correlation thing is difficult to figure out. There's no perfect answer.
No. Maybe before we jump into the kind of social media tweets topics that we always do, I know we met in Miami, but of course, Moritz, you also spent a few days at the conference the last few days. I mean, were there any interesting things you took away from the conference other than, of course, the great privilege we both had in running into Wayne, in person? Now he's not just a Twitter friend, now he's a real friend. So, but anything else you think of when you think back on over the last 36 hours or so?
Yeah, Wayne was a highlight, as was meeting you and everything. So that was a lot of fun. But in terms of the conference, I was there looking at specifically at firms trading commodities and kind of like geographical arbitrage strategies in a systematic way in those markets, and also to firms who have a physical merchants business in the commodity space that potentially allows them to get different signals than we do. Case in point, palladium. So I spoke to a firm and they were saying, look, we're running warehouses, and it became clear to us 2 years ago that it was difficult to get palladium out of any warehouse. So clearly there was a shortage, and they built up a long position. Palladium started to trend after that, but we as trend followers, we get onto these things a bit later then. So this is interesting. I spoke to a couple of people in the CTA, or say trend following space, like us who were there. They said, yeah, there's interest by people, but it wasn't overwhelming. It's not like clients were queuing in a mile-long line to speak to trend following CTAs. Yeah,
no, I mean it is true. I mean, and also I guess certainly the latter conference we attended, the context one, CTAs, even though it started out as a CTA conference, I would say CTAs has been completely dwarfed by all the other not strategies, I mean. And what was interesting from the first conference of the week, which was the MFA conference, the Managed Future Funds Association, I should say, where Preqin did a presentation about flows in 2019 and where they suspect flows will come in 2020. I mean, there's no doubt right now. Everybody loves private equity, and most of the strategies are kind of not that interesting in terms of flows. But of course, we all know that this changes once we get a decent bear market in equities, and we see that these strategies do have their weaknesses. But as long as the S&P and other equity markets continue to go up, those are the strategies that people gravitate to. That's clear.
That's interesting. I think so too. I mean, I remember the conference from its old Alpha Metrics days when it was very CTA focused, and maybe there were like 300 people there or something like that. Now it's 2,500, and you have all sorts of trading firms, from structured credit to private equity to long short equity to long only. I mean, yada yada. Everybody seems to be there. And out of curiosity, I had a sit down and a talk with two firms from the kind of like structured credit side, and definitely they are getting a lot of attention and money. So it seems to be what we're saying, like, investors chasing returns, and structured credit looks great because it produces a relatively, the last couple of years it has produced phenomenal low volatility excess returns compared to the alternative treasury bonds or something like that, right? And but it's presented in a way like, come on, you want our investment anyway, so we're charging 3 and 30, and there's like a preferred return of that. And just if you don't want to invest at least 100 million, then please step aside. Somebody else is in the line who wants to do it. So very different to us.
Yeah, but although I will say there's one theme that when you talk about that, and that does spring to mind, and that is, I think a lot of these investors, what they end up doing is they end up gravitating towards less liquid strategies, right? Structured credit, private equity, things like that, which, again, we know that once when markets really get into trouble, I mean, one of the things you need is liquidity, and we just haven't had that need for quite a while now. But it's a little bit of, I think it's a little bit of a shame to see flows like that are relatively short term in that sense, because I think people will end up regretting it. But that's the way it is. All right, I see you've already been on Twitter today a couple of times, Jerry. So,
well, I just wanted to make a comment as well on the conference, and I think it's just would encourage. I always I'm amazed that I don't go to these conferences very often, and then when I do go, I'm amazed that how much fun they are. And I think there's a big benefit to going and meeting with people and just listening and hearing what's going on and learning some stuff. And so I just had a few meetings and random meetings with friends and colleagues, and I was learning a lot of stuff, that was going to help me, what was going on in different markets or the asset raising side. So I think it's always worthwhile just to spend a little bit of time with people, have dinners and lunches and breakfast and meetings where you can keep up with what's going on with lots of different people around the world. So I think they're sort of beneficial to go. We had a fun time at the basketball game. Thanks to Andrew for that.
Oh yeah,
it was kind
big
of a blast.
Shout out. Yeah.
So meeting him and reacquainting with old friends as well. A lot of fun.
Yes. Let's not forget that was actually a really fun evening we all had together there. And actually, I noticed that the 40 in, 20 out portfolio that he runs had a pretty strong month. So people should check that out for sure. Let's jump into the today's agenda. Let's talk about some of the topics that you brought up in your Twitter feed, and then we've got quite a few questions. I don't know if we're gonna get to all of them today. We're gonna try, but there's quite a few. So let's get going.
Good. Well, my most popular tweet this week, once again, old reliable Larry Height, red meat for the trend followers. He just has a way of stringing words together. People like it, and I like it. So he goes on to say, I don't need 1 million charts or 1,000 pieces of fundamental data to tell me that Microsoft's cloud business is booming. The trend is telling me. It's telling you too. And I think, I think that last sentence, it's telling you too, just made me laugh because, I appreciate, him making it personal to me. Like, what are you going to do with this? And why aren't you paying attention to it? And don't deny this. And so I like that sort of made it for me and a lot of my Twitter followers, but just, really encouraging. And I think I tweeted something like, not only is it telling us that and we're following these trends, but there's nothing better that's going to get you in the right position than just following that trend. There's no other fundamental or valuation or anything. I mean, in my opinion, I know that machine learning and things like that, and there's just, can we figure, it's just like, can we just please try to figure out something that gets us in before that breakout? Oh my gosh, I have to wait for the breakout. Can I just buy the low with my machine learning? It'll just make me so much better. So, okay, whatever. But I think that's pretty interesting. Larry's just an infinite wisdom, and this book he wrote has so much good stuff in it.
Yeah, no, I completely agree. And I think the comment you mentioned, this thing where he says it, and it's telling you too. I mean, I think it goes back to the point we're trying to make in many different ways. But at the end of the day, it's the same point, and that is, the evidence is pretty clear. Yet a lot of people want to ignore it, and so I like kind of this turning it around a little bit. Where essentially you ask people, I mean, what's their assumption? What assumptions do they use in order to get to the conclusion that you shouldn't have any trend following in your portfolio? And I'd love to hear their response, because as we all know, there's never been a white paper written that does not come to the conclusion that trend following or managed futures, whatever we call it, should be part of anyone's portfolio. So the trend is definitely telling everyone what to do.
I read the book between Christmas and New Year's Eve, I think, and enjoyed it. Larry has, I've mentioned that before, he has the talent, a rare talent and very, very appreciated talent of using simple words and simple sentences to describe trend following and its benefits in a very clear and funny way.
Absolutely.
Yeah, he does. He's great in person. Another, so back to Morgan Housel, he's just put so much good stuff out there that I like to read. On his website, I've got a link to an article with Tim Ferriss, who I guess is pretty interesting as well. I've read a few things of his, and he tweeted something that really, I mean, this is just like me, And I sent this out to some friends of mine, and they're like, what are you sending me? Is this like a self-help thing? I'm like, yeah, I guess, but this is just me. It's really hit home with me, and this is the type of person I am. And I was like, oh, wow, this guy's figured me out. But here's the quote. It's, I'm not good at moderation. I'm better with fasting than caloric restriction. No dessert is a lot easier for me than some dessert. I thrive with loving constraints, strict binary rules that remove all deliberation and protect me from my lesser self. I'm going, oh my gosh. I love that part. Loving constraints. But I've, lost a lot of weight, and I've gone through the years, I lost like 70 pounds in 1999, and getting older, and I'm always kind of going through these, okay, I got to lose like 5 or 10 pounds to get back down to my, prime, fighting condition and working out and everything. And that's the only thing that works for me, just is this tremendous calorie restriction. And so I'm like, oh gosh, he got me on that one as well. And then with the trading and stuff, I'm always trying to be so strict, at least argue for the strict interpretation and these rules, the 10 commandments of trading. And so my brain just works this way where I need to protect myself from my lesser self, I guess, but maybe something a little bit different than that. But that's good enough, I guess. Maybe there is a lesser me that makes it me desire these loving rules.
What are your thoughts, Moritz?
I like it. I just find that those type of rules are, at least for me, much more difficult to obey than the trading financial rules, which I can backtest in a spreadsheet and kind of like say, oh, here's a signal, I need to follow that signal and I'll do it. Saying no to the ice cream, it's kind of like, oh, well, I can have one because it doesn't really hurt. You don't see it immediately as a financial loss. It may, one ice cream doesn't show up on your hips, but if you do it every day, then it does. So I guess a hard rule like Jerry's saying is the better thing to do.
Interestingly enough, so I was watching on the plane home from Miami. I was watching this documentary on Netflix called "The Game Changers," which I think is about why you want to be vegan and not eat meat and stuff like that, and all the positives. And they have different experts in to talk about these things. But I think actually, if I didn't, maybe I was a bit dozy when I saw the movie. But I think actually what they say is that restricting people 100% is not necessarily a good idea, because it's like saying to you, the only thing you're not allowed to think of right now is a white elephant. And everyone is going to sit there and think of a white elephant, right? So if you say you're not allowed to eat ice cream, that is not necessarily as good as saying, okay, but just eat one every 2 weeks. At least that was their kind of take on it, that if you forbid something 100%, people are going to be more focused on it. But I kind of...
Yeah, I think it depends on what you want to achieve. If you say, you have... I mean, let's just stay on the topic of weight. I mean, if you have... You're within the range of your target weight, and then I guess everything is fine in moderation, exercise, and, I allow myself an ice cream. No problem with that. But if I had, a target of losing 20 or 30 pounds, then I don't think this works with, I'm going to allow myself an ice cream. Then this is kind of like, if I really want to do this, if I want to be 20 pounds less in, say, 2 months' time, then it must be tough and hard rules. And it's exercise, and no, you just don't eat this. Period. And other things, you don't eat it. Done. And you have to fight through it and obey by these rules. And, I guess that's the only way then.
But of course, in trading, of course, we are very black and white, right? I mean, we are systematic traders, so we don't do discretionary trading, right? That's kind of how we interpret it. And some people, of course, will blend these things. But I agree with you, Moritz and Jerry. But and maybe it's a little bit different than what we do in our personal life. But when it comes to trading, I think you're either systematic or you're not. I mean, the whole point, I guess the other thing is, if you do any discretionary trading, or things that is not in your system, you could argue that the whole backtest that you might rely on is
I think it's a little bit of a different thing. I mean, like, we as humans, I think I've read a statistic, we eat so much sugar these days. It's kind of like uncomparable to what the amount of sugar that we used to eat like decades ago. It's like a factor of, 10 or 20. It's really wild. And our brain apparently wants that, right? You show me the ice cream and I'm like this little monkey and go, I want to have that ice cream. And it's very tough to resist those urges. Whereas with my trading, I don't get that same satisfaction from doing a discretionary trade than I do from getting the ice cream. I don't get like a sugar rush by putting up, a short Tesla trade just because I feel like it. But I do like the ice cream. So I think it's wired in a different way.
Yeah, I'm not sure it's the same for everybody. We just want to achieve good results, whether it's trading or diet and fitness and being healthy. And then I'm not sure that those two subjects are compatible, but we could keep it going a little bit longer. I do think, I would say, though, that one thing that came to my mind, Niels, when you said, if you're not going to follow your rules, then the back test may be invalid, or it's more likely to be black and white in trading than other aspects of life. But I would say that, I think that for me, I think I've said on the podcast, and we quoted Jim Simons, and that is that it's okay, at least according to the two of us, Jim Simons and me, so if y'all want to argue with that, you want to argue with Jim Simons and me, go ahead. But that if we follow our systematic approach all the time, 100% of the time, then at some point in time we say, some crazy stuff going on here. Let's reduce our leverage. Let's reduce our positions. We need to do something to cut back. And I think that is fine. And then you have that sort of in the back of your mind, or you have it systematized even better. But it's not a system trade. It's not an entry and exit and a stop loss. It's and it's not this continual portfolio management that every day you're doing something outside of the individual trades, but it's like, okay, now is a really dangerous time and I want to cut back. And that gives you the ability to not freak out and break. Oh my God, now I've got to quit trading the systematic rules. But it says, no, you can come back to it at a later time. You always have this in your back pocket, that if you're afraid you're not going to stay in the game, which is the ultimate, don't lose too much, so you stay in the game. And I think that may be akin to the ice cream thing. If you're out with your friends, I mean, I think it's kind of crazy. I mean, as strict as I can be on diet and fitness, if I'm out with my friends and everybody's getting ice cream or a glass of red wine, I mean, come on, right? You got to give in. It's bigger than your rules.
So are you thinking when you say that, Jerry, are you thinking that reducing the whole portfolio, you're not thinking about picking selected trades and say, I want to get out of those. You're thinking, let me just reduce the whole portfolio risk because something completely crazy is going on. Is that how?
Yeah. I mean, I'm losing too much money. It's high volatility. Maybe you come to this realization that you're trading too large regardless all the time. And what this does is when you do this across the board reduction, your brain is saying, oh, okay, I can still do all the trades and I'll continue to do them just at this reduced level. And I wouldn't, although, rule out the possibility that, you're in this market environment. I've been in market environments before where, coffee, it was probably, I don't know what year, 80, 88, 89, where I had this big coffee trade on and it was dominating my performance. It was just crushing me every day or making a ton of money for me. So you could say to yourself, well, I'm going to make this across the board reduction, but it's only going to be about coffee. So if it's keeping you awake at night or if it's really playing havoc with your mind and your brain and your inability to continue to do the system trades, and you are starting thinking about picking and choosing the markets, then maybe I wouldn't rule out the possibility that you just got to go in and maybe take care of one or two trades so you can sleep at night.
I think certainly from over the years, I would say that I've definitely come across people who says as kind of an overall risk reduction in a crazy situation that's part of what they feel they have to do also to be responsible to their investors. So I think that's it's not the first time I've heard that, I don't think there is a right or wrong answer in that sense. So yeah,
I mean, I think it's definitely a right or wrong answer. I think anytime you get yourself into a situation where you're putting yourself in a possibility that you won't stay in the game, then that's the wrong answer. It may not have come out to that. You may have been the winner. If you remember back, the people around Simons was saying to him, don't cut back. And they could have been correct, and he could have been wrong. I don't remember. But whether it was that particular situation worked out or not, I do think that I don't want to shy away from the fact that, yeah, it's wrong. If you keep trading too large and you put yourself in a high likelihood of ruin being losing too much money of your own money or losing enough money to where your clients all leave you, then that's wrong. And I think that, that's a problem and you shouldn't get in those situations.
No, I get what you're saying. I think from my perspective, I think as long as your performance is within expectations, even though it might be incredibly uncomfortable, but if it's within expectations, then in my opinion, I would say you have to stick with the system. If you're starting to lose more money than you've ever done before, and things are crazy, I think you're right. Then you probably have to do something. But it could also be a change of the system, right? And we know that those decisions have to be made from time to time. You want to modify your system, even though I don't think any of us would advocate that you should do it because of performance. But these things do happen. So yeah.
Well, I think that I would discourage people from trading systematically and sort of falling in love and treating these systems as sort of like the gospel and a religious experience. Like, I'm going to go down with the ship on my systems. I'm going to prove to everyone that I can hold on and I'm the most disciplined person. I think, no, don't do that. And I think trend following frequently shows us all the time, hopefully mostly positive stuff that something that's never happened before is happening. and hope most of the time we're kind of benefiting from it. We've never seen zero interest rates. We've never seen moves like this or politicians like this, and we buy those breakouts and we hold on, and it defies logic and it defies history. So it could be a negative as well, though. The drawdowns and the volatility, and do whatever it takes to stay in the game.
It's a fascinating topic, right? I mean, like Jerry says, we don't want to be murderers with our systems just for the sake of, trading the system. But I thought about ways to kind of like solve this conundrum, and speaking to other firms, like how they do it, how they reduce exposure when they're down. And there are some that say, well, value at risk is going to be reduced in the drawdown, and other will scale positions back exponentially the deeper the drawdown becomes, and all of that. And I kind of like I do something like that, but in a much less frequent way, in terms of trading a different notional account size level depending on where losses are. But it's not a function, it's not built into the system. But I guess to all of those approaches, there is the point that when you're down 50-60%, you're very likely to throw all of that out of the window, and you will make a decision to probably trade smaller, hopefully trade smaller, in order to avoid ruin. And this is, I don't think that can really be built into a system.
Well, I think that it's so important to build that into the system. And I think we do that, because I think we're essentially doing that when we make these extreme decisions to trade currencies, commodities, interest rates, fixed income, and stocks, and long and short, stop losses, paying attention to trend only. And all of these things we do, which seems so unnecessary, because you just buy the index, buy the stock index. What you're in the business for a while, you're faced with those situations where you're stressed and you're trading too large, then you sort of start trading at a more appropriate size. And so then it's very important to get all of that stuff correct. Maximum diversification, moderate leverage and risk, and daily P&L, and average losses. And then when you get hit with crap, and you're going to get hit with it, you're the best, and you have done the best job on the planet, then you get hit with it. Okay, I still have to make a cutback. Yeah, you still have to make a cutback. Maybe, if it gets too crazy. So I think that you want to do everything you can prior to that, and then get ready. You still may not be enough in rare circumstances.
Yeah, I mean, what I do is kind of like at certain points in time, I will update my notional account trading level based on performance. And on the way up, I do it, I increase kind of like the notional level, not as quickly as I would reduce it on the way down. But this is kind of like, I do that at points in time. This is kind of like part of it's not built into the system, but it's part of the routine. So it's kind of like the system. But what I don't have in the system is a rule that says this is what happens at a 60% drawdown. Because I think if I am at that level, then I will probably need to do something drastic. So to me, it's pointless to prepare in a systematic way for the 70% drawdown. You're very unlikely to follow the rule.
Yeah.
I mean, maybe maybe our difference of opinion on this point is also to do with, I think the different way we set our account size. I think, Jerry, you do it much more infrequently than we do. So, for example, if we're in a drawdown, our positions will be adjusted accordingly, meaning if the account size is, are reduced, then positions will be reduced accordingly. So that could be one difference. The reason why I'm a bit more not embracing this concept is also that, I understand that at some point maybe you say, yeah, I have to make a change. I understand that. The question is then, is that a temporary change, or do you go back and trade the original size once you start making money? All of that stuff. It opens some questions about that. But if it's a permanent change, you say, yeah, if this was wrong, should never have traded this large. I understand that. But then again, you could kind of argue the same thing as if you have extreme profitability. Do you then go in and change things? And I'm not a big fan of making changes based on these things. I would much rather that you stick with it, so to speak, and not fiddle around with it. As long as as long as it stays within expectations. If you've never lost 50% and suddenly you're down 50%, I think you do need to review what you're doing. But if you're down 40% and you've been down 40% before in your trading or in your backtest, then I don't think you need to, go to extremes.
Right. It depends upon what you and your clients have bought into.
Yeah. Absolutely. And I think that's a good point. That's exactly right. Yeah. I mean, the client should get what they expect. I think that's true.
And it's an indication that we all bought into max drawdown of 10%. And we're down 30,
right.
Or we look at my track record. I've had 40% drawdowns almost every year. No, we're down 20. No, I haven't done anything. So I think, that's implicit that, that how you want to handle those two situations. I just think it's okay to sort of say, hey, life sucks. I'm not perfect. I'm not going to, I like that word, martyr myself on these systems. It's not weakness to do whatever it takes to stay alive and continue, given my system and my leverage and what have experienced in real life and in the back test. And I do everything. My default position is to preserve capital and survive, and hopefully that won't prevent me from. Anytime I've done these cutbacks, and you'd have to do them more often when you're out of line with, your leverage is higher than you're comfortable with or your clients are comfortable with. You got to reduce that leverage. You can't. It doesn't work that well to have increased leverage and then make these cutbacks every 6 months or once a year. Don't do that. You're interrupting the system. You're not able to take all the trades the same way every time. And every time I've had to do that historically, it's been a long time since I was out of sync with all of that. I reduced my positions at the very low. You're always doing it at the wrong time. Doesn't mean it's not correct. It's just that you should expect bad luck whenever you voluntarily or have to or involuntarily have to do trades that are not system trades. It's not going to work out in the long run for you, even though it may help you survive once or twice.
And I think you're right. And I think as long as people know that this might happen, I think it's fine that, we're being transparent. And I think that, as you said, probably the most important thing is that we always have to live with what we do, right? So if we're clearly so uncomfortable about what's happening, and that's not a good situation to be in. Absolutely. Good topic. What else was in there? As I mentioned, we have lots of questions, but I know you also had some good points from the various publications that's been out in the recent weeks. So what else?
Yeah, just maybe a couple more on this. My favorite of the week was this article in Bloomberg about 16 leading quants imagine the next decade in global finance, which I couldn't find this article until Moritz tweeted it. So thank you. And I just piggybacked off of his.
You liked it. I know.
God, this was like very similar to Hedge Nordic last week, where this roundtable was just so many good nuggets of wisdom and listening to these smart people. And this was a little bit different. I'm sure these people were not in the same room discussing these topics. It was just what's going to happen in the next decade for quants. But it was a couple of them that I thought were really interesting. Cliff started off by saying, it's always important to keep an open mind to the possibility that the world might have changed. But the opposite danger of overreacting to recent performance is at least equally important. New factors are more susceptible to data mining compared to well-known ones. So I thought, that's interesting. Why is that? What does he mean by that? New factors are more susceptible to data mining compared to well-known ones. I'm not sure I understood that, but and I'm very much in favor of using all the data, not being overly influenced or overreacting to recent performance or data or lack of trends or whatever. So I like this one.
Yeah, I haven't read the article. I'm definitely going to catch up on that. But no, I mean, I don't quite understand either what he means by new factors. But we know, of course, that this factor investing, that label, it's like crisis alpha. These are labels that are relatively new in our industry, and I'm sure there are many more factors than I can think of right now, and perhaps some of them are not as robust as kind of the old school that some of those that we rely on. Yeah, no, I look forward to reading that article. Did you read it, Moritz?
Yeah, I didn't read all of the 16, but definitely read the one by Cliff and some of the others. I agree with Jerry. I don't really know about those new factors, what he means by that. But the first thing he said about the recency bias, I mean, that's spot on. And, we're kind of like case in point with our trend following performance during the past couple of years. The industry average hasn't been as good as it used to be. But what does that mean? Does that mean that you need to stay away from trend following for all times? Not for me. For some people it does. But it's a period where it's very easy to fall into the recency bias camp and just drop your investment in trend following at a time when you maybe most need it.
I'm okay with these factors. I mean, I know some of my friends, they don't like factors or this, but seeing as how time series momentum is the most popular and most respected of all the factors, then I'm good. I'm down with it, and it just seems like it's just the way that the academics have to talk and how they approach situations differently than trader types. But as long as we get positive research papers and press on time series momentum being the most important and least understood and most perplexing, it works, we don't know why type of thing, I think that's great. Another person said, today and into the future, institutions will view their portfolios all through the lens of factors. They will use factors increasingly to minimize unintended risk and maximize diversification. I mean, this is amazing. This is exactly what I've been saying, that the next phase is trend follow, time series momentum, your whole portfolio. And then I just added throw in some commodities and fixed it and FX as well. And and shorts. And so this is where the world is going, because it's what's next and it's what's right. And it's going to make everything better once we get through this period of cap-weighted stock indexes outperforming everything. Then people will sober up and say, okay, what's with these rules? What's with these factors? And once you use time series momentum and trend, you can safely throw in commodities and currencies and shorts, and we take over. Our strategy takes over. It's going to be the typical portfolio in 20, 50, 100 years or something like that. I don't know, maybe 5, who knows?
Yeah, I mean, there's no doubt that institutional investors have gravitated towards, trying to explain different strategies and performance with what are the factors, so to speak, that drives this. I worry a little bit that sometimes this can become very academic, very theoretical. And I think we lose some of that kind of market Fingerspitzgefühl, to use a German word, I guess, where there are other things that drives markets that can't always be explained and can't always be put in a bucket. And so I think there is a risk that you become too theoretical, and this is the point that I've certainly spoken to a few allocators along over the last few years on the podcast about, you can have a thesis, right? And you can invest according to a thesis, but what if at what point when the data doesn't support your thesis, do you change? I mean, and I worry that we become very... It all becomes very theoretical if we have to fit into a certain factor. And who says those factors are always right? But I do, it's like crisis alpha. It's, institutions gravitate towards these themes. And maybe that's a good thing for some strategies, that suddenly, risk parity, that's a great strategy. Well, hasn't been so great lately, and I worry when correlations go back to being positive between equities and bonds, which they are for most of the time, just not the last 10 years, then risk parity might not be such a great strategy. So anyways, just my...
Well, unless I'm missing something, my understanding is that they've just looked at what we do and mostly just applied it to stocks, of course, and said, hey, let's call it the momentum factor, and we love it, and it works, and we don't always understand why. So I'm like, fine, if that's what, it's just all good stuff from the academic community as far as trend goes. But anyways, The last one I'll say is, this is from Marco from JP Morgan. He's sort of a doomsday type of guy, but he keeps track of quants and CTAs quite a bit, and historically has been kind of famous for warning about these massive stock sell-offs. But he says quant models that are calibrated on historical data. Oh, wait a second. Let me back up. The investment world will become saturated with passive and quant strategies. And this will increase market fragility and make it more prone to tail events. The next severe recession will put the new market structure to the stress test, and that may lead to widespread failures. Quant models that are calibrated on historical data will not be able to anticipate these events. In the aftermath of the crisis, managers will aim to introduce more human oversight and discretionary decision-making in the investment process and liquidity provision. Now, I really like that, and I think that's another one of those human biases that I kind of look forward to, that when we have these trends and these sell-offs, even if we've made money, but everybody marks to the highest NAV, and so this is a really bad thing when we have these sell-offs and these recessions and stocks are down, then we're going to revert to discretion and human oversight. I'm like, perfect. Go for it. Yes, exactly. Get out of our way. Stop being so quanty and trendy. And so I hope that that's the case, that in every back of everyone's mind, except the crazy CTA types, you've got to have this human oversight, discretion, to prevent all of these bad things that are sort of happening from just following these rules.
Yeah, I think he does mention something interesting, and this is where I think we have to be careful not confusing the modern day quant world with traditional trend following, even though people say, oh, it's quant as well. But yeah, it might be quantitative, but I think it is different. Because I agree that I think that when the next time we're going to have massive stress in the system, I do worry, as mentioned before, that some of these newer strategies that may not have traded through some of the difficulties that we've done in the last, 40, 50 years, and where you will be, questioning your system and you have to make the right decision. I do think that those in those strategies with people who may not actually have had that experience, because you can't backtest experience, in my opinion. So I agree. There is definitely risks there, and there are risks that some of these quote unquote newer quant strategies may blow up, and that people who are running them will be tempted, if not forced, to make some overrides, for sure.
You cannot backtest experience, like you say, Niels. But what I'd say is you can backtest certain or quite a number of the strategies which investors use today, but they've been blinded by the light because their data starts in the 1980s. This is when most of the academic papers in finance, start to become published, say beginning of the 70s, right? So all this factor research and all that is focusing on this marvelous time period of where we had massive economic growth and expansion and globalization, and equities were, más or menos going up and yields were going down. And the best thing to do is to hold a 60-40 portfolio or some sort of a risk parity portfolio and to sell volatility. And this has produced those spectacular returns. And we're like, all the people, essentially all the people, most of the people, as RIAs or people trading in the markets, they are in this period where they look back to the 1980s, but not more than that. But you could run a portfolio 60-40 for the last 100 years. not on daily data, but you can get a basic approximation of what that would have looked like. And the picture isn't nice. The buy and hold picture is not nice in the 1920s, 1930s, right? During the world wars, all of that. Selling volatility killed you during those time periods, for sure. But people don't want to see it. And they're not, most papers don't show it to them. They focus on the last 30 or 40 years. And that produces the portfolio that is so nice. But trend following can also be tested in naive ways for the past 100 years. And it's so stable.
Yeah, and I'm just not I can't say those words. Like, I can't say, like if someone said, to a trend follower, like, you made all of this money over a 2-year, 5-year period. How did you crush it? I'd say, they would say, I followed those rules. Well, you had no experience. How did you know to follow those rules? I mean, that's what trend following does. I have zero experience. In fact, sometimes the less experience you have, when you make money and you have good performance without following the rules, that could condemn you for a long period of time. So I have my friends tell me this all the time. They didn't live through 2008. These new millennials or whatever, they haven't seen blah, 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 inflation like the 70s or the sell-off of 2008. They don't need to. They're following the trends. The person who knows the least and has the best system and the least experience and the most diversification and the best choice of leverage, they're going to crush it. And this is what we do. When I first started and I did my first back test, or I went back to the 40s and 50s or whatever, 60s, I didn't have that experience. And right out of the gate, I was having all kinds of success. Sure you were. You trumping experience with following those rules.
But I think you're saying the essential thing. You're following rules that, obviously are adaptive, et cetera, but going back to Moritz's point, the 60-40 portfolio doesn't look great in many periods going back 100 years. What I worry about is that actually the 60-40 portfolio, if you make that 50-50 and you add leverage, which should make it even worse during those periods, that's what you call risk parity nowadays, and that's a very popular strategy among certain types of investors. So that's my worry.
Yeah.
That some of these strategies that have added this extra leverage to them, but are not necessarily based on sound principle through all different market conditions. In the last 10 years, for sure, it's been beautiful.
I think some of these things are just sort of random. They've worked out randomly. I mean, we use the three of us use risk parity, at entry to make sure that we sort of have the same.
Depends on how you define risk parity. I don't feel that we use risk parity.
Oh, well,
yeah, because what risk parity for me is,
same risk per trade. But you can't leave out the part that we're long and short with currencies and currencies and commodities as well. So that's the risk parity part. I mean, I could see how it would work, but what do you think about me leaving out currencies and commodities? Oh my God, and shorts. Oh, you're not in good shape there. Your plan is going to fail. You can sort of talk about the risk parity piece, and another part of this adjusting your positions based upon volatility is sometimes when one of the two, the stock or the bond piece, is at an all-time high, and you've been in the trade for 5 years, the risk parity may say, hey, increase your position materially, and it turns out to be right at the highs. So many bad things going on with this risk parity that I think the readjusting the positions based on volatility might be the smallest of them all as far as overall risk management goes.
But and we have to just remember, just so there's no confusion among the audience, when I refer to risk parity, I refer to these strategies that are long only stocks and bonds, not what we do where we take the short side as well. That is different. But if you're long only and you add leverage and you adjust, your bonds to your stock volatility, et cetera, that kind of risk parity, which has worked beautifully in the last 10 years, where the correlation between stocks and bond has been predominantly negative, like 85% of the time it's been negative. So it's fantastic. But over 50 years, over 100 years, the correlation between stocks and bonds is predominantly positive. That means they can go down at the same time. And if you have leverage and they go down by a significant factor, as we have seen in the past, that's where I think the trouble starts.
Yeah, and but I think that there's a big problem with just trading those two sectors.
Yeah. Good stuff. Were there anything more, Jerry, you wanted to add from some of those things? By the way, what happened with this the zero hedge came out with an article, but I also saw something like zero hedge had been banned from Twitter.
Yeah, they're banned from Twitter for putting in a tweet the name of a Chinese scientist from the city where the coronavirus started, and they're like encouraging people to contact him. And so they said that's kind of harassment and abuse.
Okay. All right. Well, I think they do had a CTA article out that we probably might dive into soon. I know you've been tweeting about it this morning, Jerry. So maybe there's something to it. But let's dig into some of the questions. Let's see how far we get. First one is from Mike, who starts out by saying thanks for taking his previous question. You're very welcome. I was reading an academic paper on technical trading and currencies and found this footnote. A trend following rule in which the investor buys more as the currency goes up and sells more as the currency goes down is a dynamic call replication strategy. As the strategy produces a synthetic currency call option, the profits from the strategy should be skewed. By comparison, the trading rules here entail a fixed position that is held until the next signal of opposite sign appears. Do you agree with this characterization that it is a dynamic call replication strategy? It appears too simplistic at first. Thank you for your thoughts. So, trend following, is this a dynamic call replication strategy if we're trying to boil down what we do?
Maybe in very, very, very loose terms. But as you know, if you wanted to replicate a call option, then you'd have to continuously trade in the underlier and trade your delta and, through your gamma. That's not what trend following traders normally do. That's certainly not what I do, because I'm not as continuous in my pyramiding into a trade. I mean, I do combine different time frames. Sometimes they hit all in once, and then I have no further trade that I will add. Sometimes there's a little bit of a time gap between, one signal and the other. But, at some point it'll stop and I'll have the full position size and I will then kind of stop replicating the call, if you will. And the same is true for the downside if we wanted to say replicate the put. But then a call is kind of you pay a premium up front in order to have the benefit of getting the ride to the upside. None of us pays any premium up front. Kind of our premium is probably going to be the losses that we make with, all the 60% of the trades that don't work. But there's also an exit that we have, which a call option doesn't have. You can have a call option go, out of the money, expires worthless, or stay in the money and it pays you the intrinsic value. But we at some point will be out of the trade, and that will be a very unrelated exit to a call option expiration date. So that's why I say very, very loosely.
Yeah, I guess you could, if you just think of it conceptually, and maybe that's what Mike refers to, the fact that we advocate limited loss, unlimited profit from how we do the trades with a stop and we let the winners run.
That's
visually
the hockey
that looks,
stick payoff
exactly.
Profile.
Visually, that looks like a call option. So I understand
that's why I say loosely it is there. But we're definitely replicating a call option would mean that through our trading in the underlying instrument, we're replicating the premium of the call option that has to be paid. We're not doing that.
And as we've said before, I think I got a little confused by the question, but I think he was mentioning, well, anyways, I think before we've said we have these multiple entries and exits, multiple systems, look back periods, and it looks like we may be scaling in and pyramiding, but as far as I think the definition of pyramiding is using current open trade profit to justify, from a money management point of view, adding to the position, and I wouldn't advocate doing that. So I may have looking at my potential trade in a market, I might want to do 20 contracts of something and then split that up into 4 buys at 5 each. And some of those buys will happen, some of them may not happen, but I'm not going to increase that max number of 20 based upon having some sort of temporary open trade profit, if that's what he was getting at as well. I don't know.
Sure. Well, at least there's some food for thought for you, Mike. Next question is from our good friend Seth, one of the people who came to our live event in New York last year. So good to hear from you, Seth. Seth says, I have a question that might be good to address on the podcast. Do any of you employ trend filters in your systems? For example, say you use a 100-day high breakout entry signal, but you make sure the market's overall longer-term trend is in the direction of the entry. You might use something like a 50 over 200 moving average cross to confirm the entry signal. Thanks. That's actually something I think the three of us have discussed from time to time when we chat about these things. So what are your thoughts, Moritz, on filtering?
Well, first off, thanks for the question, Seth. Seth and I spoke over the phone a couple of days ago. It's been good to catch up. And I think it's using these filters is something that people should look into. It can be beneficial. I myself, I have to admit, I do not use it. The kind of like timeframes I trade, if the filter wouldn't add that much, or if anything, to the way I trade. So that's why I don't have it. But I guess it depends on the setup and the speediness of your system that you trade. And maybe the quality of your entry signals can improve a bit if you have that additional filter. Obviously, as always, don't add too many filters, not filter upon filter upon filter. And then it needs to be, the MACD and the RSI and this and that and the other thing. That will then probably lead to overfitting and too much of a reduced sample size to get your system into like a statistical framework that you can analyze. But a one simple filter, like the one Seth described, like you have a breakout and it also needs to be above a moving average or a moving average crossover, fine, give this a go, test it out.
I think actually the specific one that you mentioned, Seth, here, I think this is also what Andreas Kleno writes about in his book when he created those models that were trying to replicate some of the CTAs. I actually think he did have a filter that he used for that. So I'm sure it's definitely a viable thing to, as you say, more to test out.
Yeah, I agree. I think these things like this, exactly what he mentioned here, work pretty well. It's two different ways of measuring trend. Breakouts are kind of crude, and moving averages they act a little different. So combining the two, I could see how that would help. I think the most important thing in trading, in general, is not missing these big trends. The computer, if you try to have too many filters, the computer will say, wait a second, you're not doing enough trades. Sample size, of course, is a problem, but also you can't filter yourself out of these big trends. And the good thing about this moving average crossover combined with a breakout or something else would be that you're not going to get filtered out. You'll eventually get in. So that's critically important. Yes.
Yeah, and you could run some signals with a filter, some signals without a filter. I mean, if you want to diversify and you want to make sure you get in some of the trends that might be filtered out. I don't know.
Yeah, that's a good point.
Question. Yeah.
My experience has been that we would come up with stuff like this, and we were so proud of it. And it was just amazing, to refine those entries or refine those exits. And then there has been times where I think the end of 18 and certainly 2008 where they just failed so miserably. And everything we knew was right about the markets and how to approach them. You're right. I mean, if that would be a situation where I would say, adding these things or adding these ideas is going to improve it, but sometimes, don't do this all the time, or have a system that doesn't use, these filters, because that'll help you when bad ideas or the best ideas don't always work the best.
Yeah, no, absolutely. Absolutely. Next question, we'll see. It relates to last week's episode, actually, episode 72. It's from Michael. Michael writes in, I'm guessing that the comparison of daily volatility mentioned in episode 72 is between a trend-following portfolio and a 60-40 portfolio. My assumption is that it would be tough to beat a combination of S&P and bonds in terms of lower daily volatility over the last 5 years or so. I've not verified personally, though, as I don't know any trend following systems. What I do know is how to email questions to experienced trend followers. Would the host be able to divulge whether or not the daily volatility of a 60-40 portfolio is lower than that of the perfect portfolio or a perfect portfolio? An exact number would not be needed. A greater or less than would suffice. Right.
Well,
so
great thing.
I
right?
don't. Yeah. So I actually I don't have the number of a 60-40 portfolio. I don't know. But I can kind of guess that it's not been very volatile in the last 5 years for sure. I don't think that it has. But do you have any and the perfect portfolio? I'm not sure whether you have any number for that, Jerry, where you actually do trend follow everything, other than what we do in our normal programs. How do we best answer Michael with some confidence?
Well, what I say is, he's right. I mean, during the last 5 years, just eyeballing the charts, the S&P's realized volatility has been kind of like at all-time lows. It didn't realize a lot of volatility. Neither did bonds. They both were in a nice trend, and they were negatively correlated. So the resulting volatility of that combination, 60-40, is, I don't know the number off the top of my head, but definitely low. Now, we as trend followers, we can choose at what volatility we want to trade. We can now take the last 5 years volatility of the 60-40 portfolio and scale our system in such way that it trades at that level of fall. What you'll see is that we won't be able to outperform. In fact, we will substantially underperform that 60-40 portfolio and have larger drawdowns. This is the view on the past 5 years.
That's right, because essentially those are the two best trades. And if you limit yourself to the two best trades, then that's going to outperform diversification and shorts, currencies and commodities and short. Heck, we even shorted the bonds, or I've definitely shorted some of the individual stocks, that not keeping up with the S&P, doing long only is highly predictable in a current, what's happened in stocks recently. And so adding in shorts, I mean, my gosh, yeah. But they just so stumble onto the two best trends and say, oh, how would you compete against this? How are you going to do against the two best markets? Oh, I don't know. Let me check it. Look, I don't have to check it. I know how I'm going to do. I'm not going to do well. So your idea is that, why do anything else? Seriously? Okay, so we just have a gulf here between what we all believe in and what the rest of the world mostly believes in.
Yeah. And just to insert here, if anyone has a question for us before we continue, you just need to email them to info@toptradersunplugged.com, and we will do our best to bring your question on the next show. Now, the next email I got is really interesting, I think. It's not so much a question, but it's very kindly a comment, because a couple of weeks ago, I think we did a little bit of a shout out to the audience saying, if anyone has a good explanation in terms of trend following, how should we go about explaining it to people, let us know. And Brian took us up on that. So I really appreciate this, Brian. And this is what Brian wrote. On the most recent episode of Systematic Investor, you put out a call for help in explaining how trend following, or how to get it into more portfolios. Years ago, I was working at an institutional consultant and came across this paper: market vision and investment styles, convergent versus divergent strategies. And this is by Mark Rinczynski that we often quote, and Jerry, you have him often in your Twitter feed as well as a reference. I'm really stuck. It really stuck with me, and after reading it, I went through the exercise of placing all my managers on a spectrum of 100% convergent, 100% divergent. The strategies we were using probably tended to be about 85% convergent. Looking at strategies with a high level of abstraction was helpful in seeing how most of the managers we had across the firm, whether it was equities, bonds, real estate, hedge funds, etc., had a lot in common. If you're trying to put together a well-diversified portfolio, it goes well beyond balancing allocations to a bunch of different asset classes. The underlying approaches to extracting returns from inside those asset classes should be balanced across the whole portfolio too. That's how I've come to think about trend following. It's not a diversifying asset class. It's for diversifying convergent strategies across all asset classes. And I really like that personally. What are your thoughts?
I agree totally. I mean, it's what I've been saying. It's not diversified systematic CTA trend following. It's a mechanism that gets all of these markets into your portfolio safely. And he's come to the realization that it's quite a bit different from a stock index or being long all the time. It's safety and it's diversification. That's what we do. And, you can use it for stocks only, or you can use it from, trading your big stock portfolio with trend. That's very important. That's your crisis alpha. That's how you're going to help yourself, not by allocating a small amount to weird traders who trade commodities and go short. But people have different constraints. Can't do shorts, must do a lot of stocks and bonds. Okay, whatever. Just use that trend. And I meet RIAs from around the country all the time. They've been doing this for years. They allocate to Chesapeake. They have to meet people where they are and give them things that they can handle, and it's stocks and bonds, and they still can get away with using some trend and protecting capital.
Yeah, I mean, just to reiterate that, I mean, I think it's really interesting to hear someone who have been allocating across many different types of asset classes and strategies and managers, et cetera, but then when you look at it in a, so what's the decision making? What's the kind of the strategy trying to, or how is it most likely going to profit from divergent episodes or from convergent, meaning stable. So just maybe for people who are not familiar with this, but the convergent strategies are strategies that tend to make small profits for long periods of time, and suddenly they get completely crushed because something extreme happens. Short volatility would be a very easy way to visualize that. Divergent strategies is kind of what we do, where we, don't make money most of the time, but when we do, we have large outside profits because we're expecting things to change, not to stay stable. So I like that. I appreciate that. Any additional thoughts?
I think we've mentioned skew a couple of times on that podcast as well. The convergent strategies tend to have that negative skew. Jared just mentioned the word safety in relation with divergent strategies, such as, for instance, trend following. I think that's very important. But it's difficult to run them because most of the time you're wrong, and you have to wait potentially for long, long times to then make that positive skew the right tail, all right, and make a bunch of money that pays for all the waiting years. So the convergent strategies are easier for the mind to follow and more dangerous for your portfolio to take in.
That's I've said before, back to Seth's question of the 50 by 200, the golden cross, and the opposite is the death cross. 50 goes below the 200. I tweeted, and you could just do a search. You'll find a lot of smart people making fun of the last time the S&P 50-day moving average went below the 200. It didn't work. It hasn't worked the last 4 times, and that's their scientific evidence-based approach. Oh, it hasn't worked the last 4 times. Don't you feel stupid? And so this is what you're up against. You know, in 2008, of course, it saved you a monster drawdown, but that's so distant in the past, and the market came back, so you didn't even need it then. So this is the silliness that we have to put up with.
Yeah, very true. Anyways, appreciate the thought. If anyone else has good ways of describing, visualizing the trend following and the benefit of that, like Brian just did, do send it in to us, and we'll bring it up. Dave is the next. From the next question is from Dave. Let me get that right. So he writes: when using multiple lookbacks in a trading system, would it be a good practice to use the same risk per trade for all lookback periods, or could the risk parameter vary depending on the lookback length? Just curious as to what is commonly done in this regard. I think this is an easy one for us to answer. Moritz, do you want to?
Well, the answer is yeah, could it? And of course it could. But if you do that, then you're kind of like giving preference to one time frame, relative to another. I could put more weight onto a 250-day breakout than I do on a 100-day breakout, for instance. But I don't do that. I treat them all in the same way. And it's kind of like, they need to be done in the same way or not at all. If I don't like the 80-day breakout, then okay, rather than give it a smaller weight than the 250-day breakout, I'll just say, no, I don't trade it.
Yeah, and I think that the whole philosophy of knowing what you don't know, I think it lends itself well to basically treat everything equal, whether it's markets, whether it's time frames. Just don't overthink it too much, because at the end of the day, we don't know what's going to work in the future. Now, the next one is from Yohan. Let me just get it up on my screen here. So Yohan writes, thanks for an interesting podcast. I'm considering implementing a paper money trend following system just for fun. I'm a software developer by trade. Now to my questions. How do you decide when to trade during the day, and do you look at the order book to minimize slippage? When trading significant volume on a market, how do you split your trades, or is that not a problem when trading futures? Who wants to go first on this?
So my personal portfolio, it doesn't really matter that much. I've never had that much of an issue. But trading larger size for, an institution with millions and millions or hundreds of millions of dollars, then that is a different thing. And you want to know about the liquidity of the markets that you're trading. And maybe you want to spread out those executions and not just hit them all in one sweep go at one point and just focus on the settlement. But, you can either put this into your system and say, I'm going to break it up, and I'm going to trade a little bit here and a little bit there and a little later. So you smear it out that way. Or you could use an algorithm to do that for you and get you in and out of the markets.
Yeah, it's trade. I think the most important thing is just when your signal gets hit and your trade gets hit, start the trade and get it done as quickly as possible, but not too quick. Don't trade small. If it's cocoa, you got to take more time. If you have a lot of money under management, if it's the German Bund or Euro Bund, you don't have to. So it's just per market, but I think speculate with your system and not with your execution. Just get it done and move on.
Yeah, and just to add to that, Yohan, actually, if it's a long-term trend following system, I think you could even do research that will find that even if you delayed your entry execution by a day, it wouldn't make a big difference. So I don't think if it's something you're doing on a personal level that it's going to make any difference as such. Next question is from Drew. Drew, he writes in from Texas. So howdy again from Texas, he writes. I'm curious what your day-to-day looks like, with your systems being pretty well built and reliable by now, and your trading being fairly long-term. I don't sense that there is a lot of activity, a lot of active daily trading. So what are you spending the majority of your day doing? So
I feel like I'm going to be judged here. Fantasy hockey is a big one. I mean, I'm looking at the markets daily, and I'm asking my traders, how are we going to do this trade? Is it a VWAP? Is it a market? What are you thinking? So, I'm enjoying life. I'm doing some research and thinking about markets to add, markets to take away. So there's always something fun to be working on.
I agree. Same here. I definitely do not get bored. Those markets are too interesting, and developing systems is interesting. Speaking to clients is interesting. Doing research, all of that. So there's really no time for boredom. I don't need to sit in front of the computer and watch the markets all day. I guess that's one of the real positive things about being a systems trader. You can, step away from the markets and focus your time and energy on something else.
Absolutely, and I also think that there's obviously a difference you need to be aware of, Drew, in terms of our day-to-day things. I mean, Jerry's situation compared to Moritz and I, we have full-time jobs, so we do other things. But I think it depends if you're doing it for yourself, and if it's a profitable system, and you can, if that's your main source of income, you're right to some extent. It gives you a lot of freedom. I think that's why some people gravitate towards this kind of style of trading, because it should not take that long. However, I think research is something that should always be something you do. Maybe not all the day, but it's important. So yeah, but good question. We have another question here from another Yohan. Yohan writes in, he writes, if markets trend for 40% of the time and moves in ranges 60% of the time, why not combine a range trading strategy with your trend following strategy? This way, those many small losses can be offset by the profits of the range trading strategy, buying support and selling resistance. This should be diversifying across strategies in order to improve performance and decrease drawdowns. So let me take a stab at this first, Yohan, because I think actually I also replied to you by email on this. I mean, there is no doubt you can do whatever you want. I think that if you want to have the profile of a trend follower, and that's what your clients are buying, and they rely on you to be fully long or fully short when the big breakouts happen, I don't necessarily think it's a good idea to try and confuse by adding other types of strategies to your program. So from that point of view, I think most trend followers don't do that. You could then argue that, okay, maybe you have a very short time frame that could make use of short-term corrections. I wouldn't call it range trading, but different time frames sure could add some diversification to that. But I do think that where certainly in the email I sent you, where there is shouldn't be any confusion, and that is during trending behavior where you want to be either long or short, there's a lot of noise. So if you're trying to be too clever about it and having quote-unquote range trading strategies as well, they're going to suffer a lot, I think, during those during those trending periods, because a trend is not in a straight line. There's going to be lots of corrections along the way, and they may look like range trading for a range trading system and get you stopped in and out. I mean, you obviously need to, if you're doing it for yourself, you should test whether it works or not. But if you're looking for a manager, I think you'll find people who, probably are more pure in terms of being just trend. Unless they are more multi-strategy, of course, then I'm not sure they would do range trading strategies per se, but they would do other types of strategies. So what are your thoughts, Jerry? I think Moritz stepped away, or at least his...
I don't know how to put that together, because it seems to me that, it was just, I think when you do the back test, the trend following is so overwhelmingly better than everything else. Then my attitude was, why bother? And I think sometimes, especially with range, it sort of nets itself out to where all you're really doing is just trading your long-term trend following smaller. I think adding other types of strategies to trend like carry trade or shorter term trading or pattern recognition, they probably have a tendency to be you're doing trades at different times. But when I think about range, I'm thinking, okay, I'm going to buy the breakout and then I'm going to sell the breakout at the same time. I don't know how it works, but too old.
Right, because you want to get exactly. So I think what Yohan is saying is that if you have let's just say the market moves down and we're waiting for the breakout so that we would potentially sell. What Yohan is saying, well, just before it breaks out, you could say that it has maybe some support and you're going to try and buy that. But you're absolutely right. Essentially, what you're trying to do is you're trying to buy something that you actually think you're going to get stopped out straight away in reverse and go short. So. Yeah, I mean, I think you can be too clever with these things, Yohan. I think the concept of what you're saying, I can understand why you say it makes sense to do, but I think if you start testing it, it's not that easy to make that combination profitable as such. But maybe combining shorter term trend following. So obviously, short term managers, we know that. They trade very differently to what we do, and they obviously can find periods of profitability where we won't be profitable for sure. Probably like last week. I mean, last week, I'm sure some of the short-term traders had a ball, without a doubt, while we were giving back profits from longer-term trends. So combining things is not necessarily a bad idea. I still think you'll find that if you look in the very long term, you'll still find medium to long-term trend followers outperform. But they don't outperform all the time. That we know. So let's jump to the next question. This is from Paul. Paul asks, when backtesting in the futures world, do you guys include quote-unquote dead markets in your analysis, like pork bellies, for example? I tend to include it in my backtesting and trade stats, even though the market no longer exists. Curious to know how you guys approach this. Similarly, do you ever backfill futures data with cash price to provide an indication of historical performance and increase sample size? And then, for example, he mentions that the SGX iron ore futures since inception is 2013, but cash data goes back at least another decade. So does it make sense to backfill the futures data with cash to get a longer backtest period?
I love that idea. I like where he's going. He's just doing everything he can to get more sample size and include markets that don't exist. That's perfect. I like it. Then add some stocks in there, even though you're not going to trade them. How about that? And so add some markets in there that you are not going to trade, but you're getting a better sense of what the system can do and can't do. One thing that popped into my head is that be careful when you, you doing things like adding in too many stocks. So then the stocks start to dominate your backtest, or too many bonds or things like that. So you got to be careful with what you're looking at. And the best market out there at some point in time has been crude. And if you throw in heating oil and unleaded and Brent and gas oil, well, you just, now you got 6 different markets that you think you've got. It's one market basically, and you think it's 6. So a lot of pitfalls, things to worry about when you do the back testing. But I like that philosophy of using more data rather than less.
Yeah, I kind of also I get I kind of the same emotion like you were saying. Yeah, this is interesting. On the other hand, I also know that we often say, test what you trade and trade what you test. And I wonder if we're trying to establish some kind of universal parameters to trade, whether including markets that we are not going to trade anyways in that calculation is such a good idea. So I can kind of see it from both sides, to be frank.
Well, I mean, what I'm going to trade is the system. So I'm getting a better indication of my system. I might not trade all of those markets, but I think that's good knowledge to have. And I'm not, I'm not going to pay too much attention to the historical NAV, the backtest, the max drawdown, and things like that. I'm going to discount that a little bit. I'm adding markets all the time. Some of the markets have gone away. The future is going to look much different maybe the average trade, average winner, average loser, win percentage will be stable. And I'm going to get more information about those three things by looking at markets that I might not even trade.
Yeah, no, I agree with that completely. So thanks for that question, Paul. Last question today. Let me see if I can bring it up. Here we are. Short question from Singh. In this episode, I think it must be last week's episode, there were multiple references to short, medium, and long-term trend following systems. My question is, how do you define these timeframes? So we may actually have different views on that, Jerry. So it's going to come to you first, just to ask you, when you think about short, medium, and long-term, do you have any kind of clear definition of that that you think of?
Well, I don't like to use those terms when I'm trying to help clients understand what's happening. So what I do is I just tell people the look back period, and even better than that is average holding period. So I'll tell because everyone has a different opinion of medium and long term, and I don't trust medium term. I think people like to say medium. I mean medium. I mean, who can argue with medium? It's just in that place where you just can't argue with it. Oh, I'm medium. I'm in the middle. I'm not radical. And so, that's just so wonderful. So I try to avoid terms like that and just sort of say, I hold my average holding period is X, and people are like, whoa, you were really long term. So it's all kind of relative to other managers, or people are often shocked when I tell them my average holding period is what it is. So it's no doubt.
So using that measure, right, average holding period, where do you draw the line then? I mean, a short-term trader, is that someone who holds the average trade for less than a week, less than 2 days, less than a month? I mean, what just to maybe answer?
Yeah, I don't know. I think I've heard that 4 days, 2 weeks. But personally, I would think that 3 months is pretty short term. It always baffles me because when I do my own research and backtesting, I can't find profitable systems that have short, 3 month holding periods and 2 week holding periods. But I think that that's just what most people are looking for to do research. We are a research firm. We are doing backtesting and research all the time as the markets are always changing, and we have to evolve. Never said by me. And so I listen at this and I wonder, and I'm like, congratulations if you're able to trade shorter term, a look back period that's less than 6 months or 9 months, 12 months even. Good for you. I can't really comment on those type of systems. I can't get them to make profits.
Yeah, and I think also to add to that thing is that I think these terms change all the time. I memean, certainly I remember when I started out in this industry, short term was different to what it is today, because back then we weren't trading intraday stuff. You kind of couldn't. You didn't have the technology to do so. Today there's so much high frequency intraday, et cetera, et cetera. So I think these things are very difficult to have a clear opinion about. But I agree with Jerry. Average holding period is not a bad way to look at it. And then you can say, well, anything below 2 weeks is certainly short term. In some sense, and people who are in the high frequency or intraday trading, they think that's an eternity to hold a position. So I don't think there is a clear answer to that. In my own opinion, I think things that are 1 or 2 weeks, I think that's generally short term to how I think about it. Long term for me is probably more than 6 months on average. Then you're certainly in the longer term camp. And then you have this gray area in the middle, which is going to be probably labeled medium term, but that has such a wide range that it's neither here nor there, frankly. So I kind of get Jerry's sentiment about, medium term can be very confusing as a term. I think the best thing is just however you feel about it. It doesn't have to be fit in a box or be labeled as such. I don't think it really matters. People will have their own opinion based on when you tell them, oh, my holding period is 69 days on average. Well, then they're going to think about it the way they want to think about it. Yeah. I'll just run through the numbers. These are not month-end numbers, I'm afraid, because The data for Friday is not in yet for these indices. So the numbers I'm going to quote now is as of Thursday. And I think Friday was not a good day for our industry. That's my sense. So don't think about these numbers as this is the final for January. But anyways, the B Top 50 as of Thursday was up 0.8%. The SocGen CT index was up 1.64%. The SocGen Trend Index up 2.03%, and the SocGen Short-Term Traders Index up 2.5%. And the Bridge Alternatives, which I think might be as of Wednesday when I looked at the numbers, but it could be Thursday, was up 0.52%. What is interesting and not surprising, I think, is that the SocGen Short-Term Traders Index has come out of the gate for 2020 quite nicely. They didn't do so well last year. They've come out better this year in January. And I think a period like this, where you have some reversals, that's exactly where they should be excelling compared to what we do in the longer term trend following space. So not surprising to see these numbers so far this year. Any final thoughts, Jerry, you want to bring up?
Oh, wow. I don't think so. I think we hit some good... I'm intrigued by the one question we had about how to describe what we do and how to... So I think I'd like to hear more good suggestions. Maybe questions are good, but suggestions on way to talk about things and make things better. Let's crowdsource topics and in ways we can explain things better. Not just leave it to the three of us.
Yeah, no, I like that thought. I mean, I think having spent now a week at these conferences and hearing people talk about trend and other strategies, I mean, I think that coming up with a great narrative for what we do, but also why to help explain why people need it in their portfolios, like we saw earlier from Brian today, which I thought was a great way of doing it. But let's think about other ways that will appeal to investors, so we can get more people to take the brave step of including a little bit of trend in their portfolio. Not too small though, not a 1 or 2%. Let's make it more 15-20% just to make an impact. But that would be great. So please send those suggestions to info@toptradersunplugged.com. Yeah, let's wrap it up for this week. Thanks for joining from Jerry, Moritz, and me. Thanks for spending part of your day with us. We love the loyalty that all of you show us every week, and we look forward to being back with you in a week's time. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor Podcast Series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.